All right, episode number 3. This will be fun. The only problem with the episode today is that I had a late appointment at the office. So, cheers to wealth, fortunately for me.
Cheers to wealth.
And I don't know. I saw William eating a sandwich. So, I don't know. He's always doing something that has nothing to do with drinking alcohol, or we're just happy that he has his computer on today. We're gonna call that a win. We're gonna call that a win for William.
But I'm impressed by what he's done to his studio. That's looking good.
That looks really good, William.
Yeah, we got some good lighting going on, and really set the mood here to talk about some taxes and investments and things like that tonight. So glad to be with you guys for another week here.
Is that a casting couch?
I've got some lighting too.
Yeah. I see Dwight's added some lighting in his room as well. So
there we go.
Yep.
Well, I didn't realize how dark I was until I wore a white shirt on this podcast. Now I'm just like,
Well, this is my official uniform shirt now, so it seems to go well with everything we have going on.
I like it. Very good. Well, ladies and gentlemen, thank you so much for joining us today. So we really want to share. We had some really good suggestions for the podcast, and I think a lot of the stuff that we've been doing for you guys has been just kind of telling you what you should do. And I really don't think that that's the right approach here. I think that we should just kind of tell you what we do and tell you some of the stuff that our clients do and share with you some stories. And so that's how this topic came to be. And we want to share with you what's the topic, Dwight? The 5 what?
The 5 best investments our clients make to save money on taxes.
Beautiful.
Or something like that. Some variation.
Some variation of that. Which in reality, you guys have to keep in mind that a lot of the people that we work with, they already have a business that makes them a substantial amount of revenue. So like I'll give you an example. Like I was talking to a gentleman today. He's retired military, young guy in his 30s, and I mean he basically got into the financing space. So his business, along with his brother, what they do is they finance like recreational vehicles, like RVs and boats and stuff like that. And they got into this business in 2015. And right now, if I remember the numbers correctly, they're probably netting like $2.5 million. So you have to understand that depends on what tier level you're at. Your investment objective may be different. So for some of you guys, your goal is to make money. And I will tell you, like me personally, I have certain income goals that I want to hit. And so right now, my biggest priority, aside from saving money in taxes, is to have money multiply. But that requires a certain level of risk. So whenever you're looking for options to place your money somewhere, you have to be mindful of the risk. And for a lot of the clients that we work with, they're mindful of the risk. They're mindful of how is this going to help them offset their tax liability. So what I mean by that is, how can I take some of this money that I have and go deploy it into something that can now lower my taxable income? And that's really, really important, because that's a huge component of why they invest in something. So Dwight, I'll let you kick it off, man. Which one are we starting with? What's investment number 1?
Well, since you're going to let me kick it off, I thought I would start with my favorite out of the 5. And you could probably guess which one.
Which one of the 5?
Yeah.
Is it the Hairpiece LLC?
I had somebody make a comment on one of my YouTube posts about my forehead. And, naturally my hairline has been receding, but I'm just thankful to have what little bit of hair I do have.
You have more than me. I mean, I'll give you that much.
I mean, I'm blessed from that situation. My dad, he's not on Facebook, so he's not going to see this, but my dad was bald at 25. And so I'm 20 years north of that. And so I still have a lot more hair. And he was wearing a toupee even. You remember the toupees where you stick them on?
Yeah.
And I thought as a young kid, you could just take your hair off. And
I think that was the norm. He just thought people could just take their hair off.
I'd just take it off and he'd wash it in the sink, put shampoo on it. And
I'm sure he's going to appreciate that. I'm going to make sure he gets a copy of this video.
yeah.
It's going to be good. Now go ahead, man. So what's investment number one?
So the best investment personally, I think, is real estate. And, a lot of our clients, they like real estate investing. All three of us are real estate investors. So we enjoy working with people that also like to invest in real estate. And real estate, I know you're a financial guy, Raul, but in my opinion, just from a tax savings and wealth building component, real estate's the way to go. It's got two components that we like, and it's the best way to build wealth, I think. You've got an appreciating asset that you have, and an example of this would be a client that I guess came to us about a year and a half ago, and he was in the process of building some apartments. And initially, the plan was for him to build the apartments and then sell them. Well, he would have incurred a major tax liability, from the gain of selling that apartment complex. So we were able to show him what it would look like if he kept those apartments. And, mainly from a tax saving standpoint, we really didn't even consider the appreciation and that type, the benefits that go with it. And out of these units that he ended up keeping, by the time we did a cost segregation study and took advantage of bonus depreciation, which, this was a couple years ago, so it was at 100% bonus depreciation, he saved in real taxes, his portion, about $350,000. And his net income for the year was about that same amount. So it ended up pretty much zeroing out, any tax liability. And now he has an asset, that he can hold on to that's generating rental income. And, by the time he takes his expenses and then the regular straight line depreciation, there's really very small taxes or, very small rental income being generated from a taxable standpoint. And I think that's important for the viewers to realize, with rental property, by the time you take the expenses and subtract the depreciation, you're typically left with tax-free income. And that's another good benefit of real estate and real estate investing. And, had he sold this, like most people do when they do a development, now he's got to go and repeat that for income. Because once you sell it, you no longer have the income from it. So you've got to keep repeating the process. And now by him holding this, he has an asset that's paying for itself and the major tax savings that came along with it.
Well, I remember one of the other clients that we have, and he's since become a real good friend of ours, and we've actually invested money with him. When he first started working with us, and he's very heavy real estate, but he was just buying and flipping real estate, and that's great to make money. That is great. I mean, realistically, the easiest way to make money with real estate is you buy a property that needs work, you fix the property, you sell it, you keep the profit. And there's different ways for you to finance that. We won't talk about that on this podcast, but we can talk about this on another podcast. So how you can actually finance a real estate deal and flip it with very little money. But the problem is that every time that you sell the real estate, you are creating a taxable event. So a lot of the stuff that Dwight was saying, and one of the reasons why wealthy people like real estate so much is because you buy it, you fix it, you rent it, and then what you can do is you can take a loan against it, that's when you can do what's called a cash out refi or a home equity line of credit or whatever. But that loan component, because it is a loan against the real estate, you don't have to pay taxes. So you're able to take the depreciation from the asset. There's some rules and regulations that you have to abide by with that. But you can take the depreciation on the asset, and yet you can still pull the money out and go and use it for something else. In spite of what Dave Ramsey may tell you, which, he just says that you never borrow money. I think that if you are not disciplined with money, you should never borrow money. But if you want to build wealth, the only way you're going to be able to do that is by borrowing. So we'll talk about that on a different show. But William, what's your take, dude? Or you got any stories for us?
Well, I do have some stories for you on that, but one of the key components that you're talking about there is the leverage of the real estate. So that's one of the reasons why borrowing money from the bank allows you to build more wealth in real estate, because you can put down 20% of your own money, let's say, and leverage up 80% of that. So what you may have only been able to buy $200,000 worth of real estate, let's say, now all of a sudden you can hold and control $1 million worth of real estate by leveraging. So that's one of the keys with real estate investing, and why it makes it such a great option for people, is the ability to leverage other people's money to build your own wealth. It creates the cash flow for you. And then you have, like you said, the depreciation and the other expenses that by the time we take that, and depreciation really is more or less a paper loss. It's not a out-of-pocket deduction that you have to come up with cash for it. So the depreciation is huge in real estate, because that usually will cover up most of the cash flow income that you had on there. So not only do you control an asset that you've leveraged, you've got an ability for it to appreciate in value while you're enjoying cash flow. And so it's really, that's why we advise people to hold on to some of their real estate, because it builds long-term wealth, but also protects you against taxes that you might incur otherwise. And one of the stories that I've had from clients that get into flipping a house, they put down on paper, this is what it's going to cost me, these are our repairs, and this is what we're going to make. And then comes time for the taxes, and they're surprised at how much tax is paid on that, because that is just ordinary income when you're flipping a house. And so not only is it subject to federal and state taxes, a lot of times it's also going to be subject to self-employment taxes. And so you can pay 30 to 40% taxes on your flip. And if you continue to do that, it becomes an exhausting thing. So there needs to be some combination of flipping houses to generate cash so that you can invest in other properties. But like Dwight was saying, it's good to sell some. It's also good to hold on so that all of that can kind of offset. And that's why it makes it a good investment from a tax standpoint, but also wealth building.
And I think that's the key there, William, is there's got to be a balance. I love flipping houses. I mean, I've said this story before, because of a flip house is how I bought my first tax office. But when you are an active flipper, there has to be a balance between properties that you're going to hold. Then, on paper anyway, we're experiencing some losses with the depreciation, and then using that to help offset the income from to that. One of my personal clients, he made a lot of money flipping houses, and he just didn't want to deal with tenants. He just didn't want to deal with the rental part of it. But when we broke down a plan, and he realized if he only had to hold 5 properties to make it work, to make an impact on his taxes. He's like, I'll do it for a year. I'll get the tax savings, and then I'm switching it over to a property manager. Because really, by the time you bonus depreciate the property, we've squeezed a lot of the tax savings out in the first year. So after that, it really doesn't matter if you hire a property manager. The key is to do it the first year and really get the tax savings out of it.
Well, and for those of you guys that may not understand what bonus depreciation is, and we won't get too much in the weeds because we could talk about that for a long time. But bonus depreciation is where you buy a piece of real estate, and then you're able to take a huge component of the value of the structure. You can't depreciate land. So assuming that you buy a house, and let's say the house is worth $500,000 with the land, Well, you have to subtract land out of the deal, and you can depreciate the house itself. You can bonus depreciate a portion of that house against your income. So you're buying real estate and you're saving money in taxes by taking that depreciation in 1 year. So when Dwight's talking about the bonus depreciation, that's what he's talking about. That's a whole nother podcast that we'll talk about at a later date. But real estate definitely something very popular with a lot of the clients that we work with. So let's go on. What's number 2?
Well, and we could probably have done a whole podcast just on the real estate, right?
And we will.
So that's a small component of what we're going to talk about tonight. Well, you're a financial guy. Why don't you go over the second one? What do you think?
Which one was the second one? Hold on.
The 401k retirement. The 401k.
I think we said number 2 was oil and gas, right?
Well, you can do that one. You like that one too.
And did we put them in sequential order or just doesn't matter?
There's no order.
Okay. Well, let's talk about the 401k. Actually, let's talk about the 401k because actually, a really good friend of mine, and I told her to come watch the podcast. So I hope she's here. She's married to another really good friend of mine. She was asking me if it makes sense for her to contribute into a 401k, and I told her yes. And so for a lot of our clients that we work with, they own their own company, so they actually have to establish their own 401k inside of the company. And that can give them some pretty hefty tax write-offs because you have to keep in mind any money that you throw inside of a 401k is not going to be reported as income for you for that tax year. So like to do easy math, let's say you made $100,000 for the year, but you took $10,000 of that and you threw it into a 401k, then you're only going to report $90,000 worth of income for that year. And so this is definitely a suggestion that we make to clients. There's a lot more that goes into that, and there's a lot more planning long-term that goes into that, but definitely something to consider. So for those of you guys that are watching, a 401k can be a great instrument to tax defer money. Now, eventually at some point you're going to have to pay taxes on that 401k, but then that's when doing Roth conversions and other strategies are really important, and there's a lot of stuff that we can get into there, but a 401k can definitely help you, and especially when your company gives you a matching contribution. Now if you own the company, well, you can definitely give yourself a matching contribution at that point, right? You can contribute as much as you want to the maximum, and then your company can contribute on your behalf to the maximum. Now you're throwing what's the limit for 2024, William? It just went up, right, for the profit sharing and the employee contribution?
Yeah, it's 23,000 on the employee side, and then if you're over 50, you can add another $7,000 to it. But then ultimately, the thing totals out if the employer offers a profit sharing up to 69,000 this year.
Nice. So that for you business owners that are making some hefty revenue with your businesses, you could throw up to $69,000 into your 401k. There's other retirement plans where you can throw more, 200, 300, 400,000, but we won't talk about those today. We'll keep it exclusively to the 401k. The 401k is in the market. I understand that, but it's really, you just have to look at the 401k as a savings vehicle that later on, we're going to figure out how we take that bulk of money and convert it to Roth. But that would be a conversation for a different day. So definitely not as popular as real estate, but 401k is one. What's the next one? William, you want to take the next popular investment that our clients make to save money in taxes?
Oh, and the oil and gas investments.
Go ahead. Go with that.
Yeah, we this one's popular. Because we advise a lot of clients based out of Texas, so they understand oil and gas and things like that. And one of the unique things about oil and gas is you're making an investment, but then you get a tax deduction for that investment. And depending on what type of funds that you use for oil and gas, there's different types of setups for it. But it's as much as, say, a 40% write-off in 1 year up to a 90% write-off. And so those are pretty significant deductions. So let's say if you have a 90% write-off fund that you're using, and you put $100,000 into that fund, you've got a $90,000 tax deduction just from that investment. And more likely than not, that investment's going to return some additional cash flow and income to you. So like the real estate, it gives you some good tax deductions, but then it gives you the opportunity to participate in the upside as well. And then, of course, we got other funds that may not be as much deduction on the front end, but it gives you a somewhat of a better return on the backside as well. So really just kind of depends on how much deductions you need, how much risk you're willing to take on some of these oil and gas investments. But it's one of the things in the tax code that's really, it's not a gray area. It's allowed for. So when we're doing tax planning, a lot of times people will ask, is what you're doing supported by the IRS, or is it a gray area? And so in this particular area, it's in the tax code that these deductions are allowed. And part of it is allowed. The concept behind it is once we drill for that oil and gas, then the oil well, so to speak, is depleted and depreciated as the oil is produced there. So the big bulk of the expenses is also through depreciation and depletion. So it's another great way to deduct some income from your tax return, but also gives you a chance to participate in some investment returns as well.
And what was the percentage again? So like, let's say if somebody wanted to contribute like $100,000 into an oil and gas fund, how much of that would be depreciation against their active income?
It can be as high as 90% of the contribution. And on the low side, we've seen some at like 40%. And so the idea is that the 90% is probably a little bit more riskier than the 40, but it also, anytime there's a big risk, you've got a big upside for income as well. But one thing we also discovered when we were advising clients on this is it depends on the age of the oil well and if it's already been depreciated along the way and stuff like that. But these oil wells are being turned over, changing ownerships and stuff like that along the way. So it restarts a lot of the depreciation on this. So yeah, it's a good way to put some money out there. And plus, a lot of our clients, as Dwight knows, they love to say, I'm invested in some oil and gas. And so that gives them something to talk about at the cocktail parties as well.
That one in Bitcoin. Yeah, both of those are great conversation starters. Yeah, the gentleman that I spoke to today, great guy by the way. He has multiple companies, and one of them is obviously that financing for recreational vehicles, and then the other two companies, one of them is a crypto mining company. So like he mines for Bitcoin. And that's definitely a much cooler business than financing RVs, right? So he's like, yeah, eventually I want to sell the financing business, and I just want to focus on the crypto stuff because everybody always likes to talk about crypto. It's just it's definitely a cooler concept for sure. Awesome. What's the next one, Dwight?
Well, I had something to add on oil and gas real quick.
Go ahead.
The cool thing about oil and gas too is the return, and William mentioned it, but you know, the fund that we're using currently, the minimum return is projected to at 23%. And you know, in my opinion, if we're going to spend money, it's best to invest it and get a return. You know, a lot of times people are buying vehicles as a way to save money on taxes, and that's A, no investment, and B, no return, really, you know, for that spend. So ideally on these oil and gas funds, you're going to make the investment, and then within about 3 to 4 years, you're going to get your initial capital back. Plus the oil and gas can help offset a variety of income. And so this is great for W-2 income earners. You know, we talk a lot about, you know, people need to be business owners, but for the W-2 earners out there, they're making a lot of money. This would be a good investment. And it, you know, the way you enter the fund, the way they do it, you would be able to offset your active income from your W-2. So it's a great investment for W-2 earners. Also helps offset capital gains tax. So if you have a capital gain that you're looking at, you maybe don't want to do a 1031 exchange, oil and gas would be a good option to look at rolling into. And to get back to real estate, just real quick, what's cool about the oil and gas is if you're not able to qualify as a real estate professional and you're not able to use those losses that are generated, by the depreciation, that rental activity becomes, it's passive anyway. A rental activity is passive. So now you've got passive income from your rental activity, and your oil and gas can help offset. So you've got these losses that are generated from your rental activity that you're not able to use. They get suspended. Well, in year 2 and going forward for your oil and gas, you're going to start having some passive income from the returns. So that passive income from the oil and gas gets offset by your passive losses that normally would be suspended from real estate if you're not able to qualify as a real estate professional. So,
and passive losses don't carry over, right?
yeah, they would. Passive losses, if you can't use them, they get suspended and they just carry to the future until you are able to use them.
Got it. Okay. So
Yeah.
so basically what you're saying is, and I know what you're saying, but I'm just kind of trying to add some clarity for the viewers. Generally, when you are not in the business of real estate, part of the reason why that real estate can't help you minimize taxes is because it's passive income and they're passive losses, and your income problem is active income, so you can't use passive losses to offset active income, correct?
Right. Yeah. Thanks for clarifying.
But whenever you invest in one of these oil and gas funds, now you have an investment that is generating you passive income, and now you can take the passive losses from real estate to offset your passive income. So basically it's a wash is what we're doing here.
Right. And that's, the basics of tax planning. We're trying to use losses, of one nature to offset, the same losses from a, different activity, but, either passive and passive or active and active, can help balance each other out.
But when the money goes in, and so you're talking about the W-2 wage earners, so like imagine if you're a doctor, you're making $350,000 a year, and you have $1 million sitting in just a liquid money market or whatever. You could take $200,000 of that and invest it into an oil and gas fund, and now you just reduced your taxable income by maybe $160,000 just by taking the $200,000 and investing it into an oil and gas fund. So that's very, very powerful, especially for W-2 wage earners, because W-2 income is one of the hardest incomes to make go away. So definitely a strategy that you should consider would be an oil and gas fund. So very, very cool. Awesome, man. What's next?
Well, this one may be up your alley too, because I wanted to talk about contributing to a traditional IRA, but converting that over to a Roth, because a lot of our clients that we deal with, they make too much money to contribute directly to the Roth IRA,
right?
And there is no income limit on a traditional IRA. The only restriction to a traditional IRA is the amount of money you can put in each year, and there's some income limits that once you exceed, you can't deduct that contribution on your taxes. But anybody on their income, based on their income limit, can still contribute to a traditional IRA and then convert it over to the Roth IRA. Now, sometimes depending on how that conversion is done, you are incurring some taxes because, with the traditional IRA, the money going in is tax deferred. You haven't paid money on that tax, or you haven't paid taxes on that money. So then when you move it over to the Roth IRA, where it'll never, ever be taxed again, the IRS wants to get their cut of that contribution. And that's what we have come to know as the backdoor Roth IRA.
Correct. And so if your income is like sub 200,000, this really doesn't affect you a whole lot. You can just contribute directly into a Roth IRA. But assuming that your income is 300,000 or 400,000, you make too much money to contribute into a Roth, then at that point, what you can do is exactly what Dwight said. You can contribute into a traditional IRA and then do a backdoor Roth. So we're making the traditional IRA contributions, and then we're taking those contributions and converting them to Roth. So that's a great strategy. What I tell clients is, because like Dwight mentioned, like assuming that you make like $150,000 a year and you're contributing to a traditional IRA because you want to lower your taxable income by whatever the contribution into the traditional IRA was. I would just say make the traditional IRA like really hefty, like 75, 100, 150,000, like just a good amount. And then let's do a Roth conversion on the full 150,000 and implement some strategies to mitigate the taxes like all at once in 1 year. So that way we're basically converting all the money from traditional IRA to Roth in one tax year. I just like that better. I think it's cleaner, and I mean, there's different ways to dice it, but yes, definitely a traditional IRA, really easy. You can still make traditional IRA contributions right now in 2024 for tax year 2023. So for some of you guys that are looking for some tax savings, that might be something worth considering. So I like that one. A traditional IRA is just very easy to set up, and then there's a whole bunch of things that you can do with that. You can self-direct. We won't even get into that because that's just a whole nother can of worms. But there's a lot of things that you can use your traditional IRA for. I'll just say that, and we can talk about that on a different show. But yeah, very powerful. William, you wanna give your take on the traditional IRA?
Yeah, because I think a lot of times people might overlook it as an opportunity, but even for a high income earner that may not be able to contribute to a traditional IRA, the rules for that only apply when you're trying to take a tax deduction for that. So what you have is they're not eligible for a traditional IRA, but you're also not eligible to contribute to a Roth because of your income, let's say. But nothing's stopping you from putting money into a traditional IRA and just don't take the tax deduction for it. And then you can convert that traditional money into a Roth basically the very next day if you wanted to. And now that money is tax free, grows tax free, and you don't have to take an RMD on a Roth as well. So a lot of opportunities there to get that money into a Roth bucket, and that is a great opportunity because as people and taxpayers and all get into retirement, there's different strategies of which bucket you want to take money out of when you got Social Security and pensions and Roths and all of that. But ultimately, getting that retirement income to a Roth is key to a healthy retirement. But also, like you were talking about, we've got strategies now that people may not be aware of on that conversion because it had always been in a traditional sense that people were considering if I make that conversion, I've got to pay the taxes now. And I don't know if it makes sense to pay taxes now when I can just wait and pay them later, especially if you're taking a lump sum. But if we have the ability, and like we're working with a few clients right now that are getting close to retirement age, we're going to help them convert that money to a Roth and then have some strategies to offset that conversion. And then essentially, for those clients, they've gotten a tax deduction of all that deferred money when they put it in, and now they're going to get to live off of it tax free. I mean, and that's why we try to get clients to understand sometimes we know you may not like a retirement plan or any, they just don't want to put money because they don't want to tie that money up. But when we have powerful strategies to then convert that money into a Roth, it's pretty powerful to go ahead and put some money in that retirement account, especially when you consider like the tax savings that we're already doing. So like you talked about the doctor that has a high income, if we use some oil and gas, contribute to some retirement accounts, and then now some of that real estate that may not have been tax deductible to pass through against active income may all of a sudden start getting there once we get all the strategies going together. But the conversion from a traditional to a Roth is one of the great wealth buildings, especially when you get into retirement, that you can cut your tax bill by having that tax-free income.
Well, it's funny that you say that because one of our clients, a great guy, man. He's always just brainstorming with us and just a real cool dude. But he had a lot of money. Well, he still does. We're actually looking to implement that this year in 2024. But roughly, I think if memory serves me right, maybe like 1.3, $1.4 million in pre-tax of traditional IRA money. Like a lot of that came from 401ks and just different sources. But basically, it's a bucket of money with $1.3 million that has been taxed. He hasn't paid taxes on this. So every year he had been taking a chunk of that money, doing the Roth conversion, paying the taxes. But he doesn't want to convert too much money in 1 year because then he's going to have to pay an astronomically large amount of taxes. Because you have to keep in mind, if you have $1.3 million of pre-tax retirement money and you convert it in one tax year, now you're going to show $1.3 million of taxable income for the year of conversion, which is not a problem as long as you have a plan for that conversion, which we do. So we're like, dude, let's just convert it now. Let's just convert the whole thing. He's like, we can do that. It's like, we can do that. And so we put some plans in place, and yeah, I mean, that seems like what we're going to do here in 2024. And now all of the money is sitting in a Roth bucket, and now he can go to town with his Roth. And I believe he's roughly around 56, 57. So it's just a very powerful strategy, but circling back to it, it has to start somewhere, and it starts with a traditional IRA. So not a bad place to put funds.
Now, is it an IRA or an IRA?
Depends on what part of the country you're from.
Is it pie
or is it
or
pie? I mean, in Harlingen, Texas, it's pie. In Tennessee, it's pie. And in Georgia, I don't even know if you guys eat pie in Georgia.
Shoot, yeah, they do.
Only on Wednesdays at the old Charlie's because it comes with your lunch.
I'll be right back, guys. Let me go check. I heard something at the door. Hold on.
So there's a no Charlie's. The ones around here have closed down.
I was gonna say we still have an O'Charlie's out here. So yeah, Sunday brunch and Wednesday lunch is still got some good things going on there.
I see some people. Who are these people?
What the hell?
Oh, we have a guest. We have a guest.
Look at this guest.
Is it Raul or what?
Our first guest. Yeah.
We literally walked in here and I was like, who's in this building?
Can you see us?
Yeah. We did not plan this. Like, this is weird.
We have a cameo.
What's up, guys? Oh, this is Kyle.
He ought to just take the chair at this point.
Like, no, we're coming to get his laptop. Weird.
Well, it's because I heard a noise. I was like, guys, I'll be right back. I think somebody came in.
Are y'all live?
Yeah,
what's up,
live.
guys?
Live.
How you doing?
Yeah.
Hey.
Well, that was interesting. We were like, why are all the lights on?
Yeah.
So we were freaking out, and I thought Justin was here.
No, it's because I saw a client, and I didn't have time to make it home, so I was just like, let's just do it here.
What's up, guys? What are y'all talking about?
We are talking about the 5 investments that
y'all come up with
that people make
They're
to
live
save
on
money in
Facebook.
taxes. Yeah. So we were talking about we talked about real estate, oil and gas, talked about traditional IRAs, talked about 401ks. We were on the
backdoor Roth.
Yeah, the backdoor Roth.
Yeah.
That's
William's favorite.
Yeah, it's definitely William's favorite. Yeah.
Oh, this is so funny.
Well, do you have anything to add?
What's that?
Do you have anything to add to our top 5? Maybe a
top
bonus?
5, what was it? Type 5 tax deductions?
We already talked real estate. Real estate was the first one.
Yeah.
Oil and gas fund. We already talked about that.
That's a good one.
401k.
Got it.
Traditional IRA.
That's good.
The
business.
So
Business.
that was the one that I had brought up, and then Dwight had brought up an HSA, but I think the business one is better. So let's talk about the business. Business is a tax strategy, investing in a business.
Investing in your business or a business?
Your business or a business or whatever, just business altogether.
I mean, I think that's a tax strategy. I think what most people miss from business from a tax strategy for business, I think what people miss is the opportunity to structure it like Dwight would say an S corp, or to have fringe benefits, or like that's the reason people would set up a business. I wouldn't start a business just as a hobby, because you're going to pay self-employment tax. You have to make money to be an S corp. So unless you're going to show a negative, and then that's not really, I mean, it is a strategy, but I mean, it's kind of that's kind of a crappy strategy. Like if you're just going to lose money, it's a crappy strategy, because now you're like playing with the IRS. I mean, I'm not saying it's a bad one. You get what I'm saying though?
But what if like you open a business like in October right? So now you can take all the depreciation components of the stuff that you purchased for the business. So obviously the business is not going to be profitable in those 2 or 3 months.
That could work.
Or maybe it's slightly profitable, but the intent is for it to be profitable in January. So now you can take the depreciation in November for the previous tax year and make it profitable the next tax year.
So a question would be to one of these gentlemen here: does what items classify or qualify from a depreciation standpoint that are startup costs? So, like, say I, are there some assets that are qualified as startup and those that are not? Are they all just treated as normal everyday expenses? Does anybody know that? You know what I'm talking about? Like if I open an accounting business or a tax business and I go buy a bunch of furniture and I buy a computer, I buy software, I buy all this stuff. Certain things are classified. I just don't know if the assets are. I just don't remember. So some of you guys would know, but some things are classified as startup costs, and those are limited to losses in year one. I just don't know which ones are.
Yeah, so mainly the expenses that you incur of things to get it going. So if you had supplies and different things in that case, but the furniture and the computers and those would be classified as assets. But the key is to get those placed in service to be able to take the depreciation. But like the startup cost, it's limited to $5,000 typically, but the business has to be functioning to get those costs. So
yeah.
Insert,
the day you start, you put yourself out to pimp.
Yeah. So even though you may want to start taxes in January, you want to open up that office in December.
Well, I think that's a great. Just find the Samsung remote. I think.
Oh, is he looking for his charger?
No. My charger. Whoa! No, it's the power thing. Okay. So I like these things. There's a lot of clients when we were first starting in tax preparation that would do this. A lot of clients, they'll start a business at the end of the year and then have expenses related to it. The only problem, what I found, is that a lot of them weren't legitimate businesses. And this is not me telling anybody not to do it. I would just say it has to have legitimate purposes, and you have to have, but that's only a 1-year strategy then if you're really trying to make money.
Right. It's
only a year 1 strategy. It wouldn't be for like 2 and 3. If you're just planning to lose money, it's not the best strategy. You guys mentioned all the better ones.
Yeah. Well, and there are other very particular types of LLCs where you can have losses in year 1 and then be profitable in year 2, but you're not necessarily very, very actively involved in the business. There's ways to structure that, but definitely starting a business, I always think, has to be the first investment, especially for W-2 earners. Like that's got to be the first go-to. And in year 1, if that business loses you money, if you make a good amount of capital injection into that business in year 1, and we're not profitable, then at that point, then those losses can be utilized to offset your income. So I know that one of the things that comes up. Thank you, David, man. Yeah. You guys hang out. So I know, like, one of the things that I always tell like people that get paid via W-2s is you have to start a business, and you have to understand that the business is it's a financial investment. It's an investment, but then it's also such a great tax strategy, because assuming that maybe, I don't know, you make $150,000 from your job, and maybe you have $200,000 or $250,000 just sitting in the bank. You're like, man, I want to start a business. I want to take $50,000 or $60,000 of this money that I have sitting in this bank account, and I want to go and start a legitimate business. Well, if you go and dump $60,000 into your business in year 1, let's say you do that towards the tail end of the year, and maybe the business only made you like $5,000 because you just started it. Well, you made $5,000 of income, but you had $60,000 of expenses. So now that $60,000 of expenses, as long as we can figure out a component to take those losses, can help you offset your W-2 wages from your job. So you started a business that could potentially be your new source of revenue. You're taking losses, and you're offsetting the taxes that you were going to pay the federal government through your job. And then now you have a new quote unquote investment, a new quote unquote business. I don't know. What's y'all's take on that?
Well, my thought on this was making an investment in your business. So a business that's already been established,
okay,
not a startup, but at the end of the day, you do need to put some capital back into your own business, whether it's hiring staff, whether it's, machinery, equipment, vehicles, even. I think the problem with a lot of the vehicles and equipment type stuff is that's kind of a year in thing when they haven't done any tax planning throughout the year. And the person that they're working with is a tax preparer and not a tax strategist like we are, where
Right.
we plan throughout the year. And if we're recommending, a vehicle or machinery or equipment purchase as an investment in your business, you really do need that. It's a necessity. It's not, oh, well, go do it to save some money on taxes. The taxes obviously are part of just kind of I guess the icing on top of the cake.
Right.
So that's the way I thought I wanted to approach the fifth one. Was you've got some excess capital and you're going to use that. Hey, Dave, have a good night, man.
Come by tomorrow.
And then you're going to use that capital to basically reinvest in your business to keep it growing. And a lot of people they look at their payroll, they watch it, and they look at their payroll as an expense. Well, if you're hiring the right people and you're training them, your payroll should be an investment. Just like these other investments that we've mentioned, where you should get a return, an ROI, so you should get a return on that investment that you make.
I like that.
That's my 3 cents.
Well, I'm gonna let kind of William give his thoughts on this, and then I got some thoughts to share. But what do you think, William?
Yeah, I think as a strategy, starting a business, buying a business, ever how you acquire the business, obviously that first year you're going to have a lot of startup costs, depreciation, things like that you have. So that can offset what was your active W-2 income in that first year. And then as you progress in that business, get into year 2 and beyond, like Dwight was saying, making the investments. And that's the key when you're starting a business, is that the business is making money, but you as the owner can't really spend all that money that's coming in, and shouldn't spend all that money. That money should be put back, and you should have some type of budget that you're working with to ensure that some of that capital is being reserved, because as the business grows, hiring employees, and you should be on the lookout for good employees for your business. And they may not come through traditional means, but you may be out in public or places and discover that somebody would be a good employee for your business, and putting that money into them and getting a return on that. So one of the things that we'll see sometimes is business owners are hesitant to spend some of the money that they've made. But if it's from an investment standpoint, that investment will make a return to you as a business owner. And so not only are you going to, let's say you hire another employee that helps free up some of your time in your business. Well, you're getting a tax deduction for that employee. So you're not paying the full cost of the employee to start with. But also it could allow you to generate additional revenue. And also your employees, the more employees you have in your business, then they start to attract people that they know to your business. So ultimately the business just grows from that, but it starts with making that investment in the beginning.
Well, the only thing that I was going to add to that was, there isn't anything more valuable than time. And one of the guys that I follow, his name is Alex Hermozzi, which is probably the smartest dude that I've ever followed. He's just a top-notch business entrepreneur that, worth, I don't know how many millions of dollars, but just really top-notch guy. You can find him all over YouTube because his information is just so good. But one of the things that he said was, if let's say right now your business is netting you $350,000 a year, like that's how much you make profit after you factor in all the expenses of your business, but you have to be actively involved in the everyday activity of your business, you get to make $350,000. He's like, what if you took $150,000 of that and you hired someone that now is going to manage your business with $150,000? You should be able to hire somebody good. So now you're only profitable 200,000, but you no longer have to be actively involved in your business, which means your business is making you 200,000, but you have bought all of your time back for 150,000. It's like that's when life drastically changes, because now you just bought all your time back and you're still profitable 200,000. Now you can do whatever the hell else you want to do. And that's where, for business owners, once you start figuring out the leverage component, and the business owners that really learn how to do this at a high level are the ones that really excel, because now you have the freedom to go and do other things, and you just have more time to continue to grow your wealth and get into new endeavors, new exciting things. So I think what you're saying, William, just finding the right people and investing in the right people is always going to be very, very optimal for the success of your business.
Yeah, for sure. I mean, that the people in your business are one of the biggest assets that you've got, and so you have to realize that, and providing the opportunities and the feedback, and also giving them opportunities to do things for your business. And it may not be, quote, as perfect as you would have done it yourself, but it's still getting done. And I think that's a big thing too, is that delegate some tasks, and let the team fulfill on those tasks. And you may just be surprised at the outcome, that it's pretty good. And it doesn't matter that it gets done a slightly different way, as long as it is getting done and keeping the clients and customers happy in your business. I mean, that falls on team members as well. So yeah, it's a big investment. But overall, the strategy of having a business is a good tax strategy, because that's where most of the tax deductions that you're going to get come through having a business. That's very difficult to get just on a W-2 side. But you don't have to just jump ship. Like you said, you can start a side business and continue to work your regular employment while you're building that business and learning some things along the way. And then at some point you decide on the jump off point, which honestly, I think one of the metrics on that is whatever you're making in your W-2 job. If you start making about half of that in your side business, that's probably the point to kind of consider going full time in that, because you'll have a lot more time to devote to your business, and it's showing that it's viable. Once it starts producing and making money for you, then you know you've got a business that the market will support, and so that's a key thing there. But yeah, the tax deductions in the business is where it's at.
So right now that you mentioned starting a business, I know that I got some heat from some people watching on some of the previous podcasts when I was dogging the multi-level marketing guys. I assure you that I'm almost 100% certain that there are some multi-level marketing companies out there that actually do some great things for people. I haven't seen that to be the norm. That's probably the exception to the rule. And if you are a part of one of those organizations, I would love to hear from you, and I'd love for you to at some point hop on one of these podcasts and just kind of let us know, because we definitely want to promote that. But and you guys can tell me if you have seen like something different than what I have seen. But I have seen the majority, not all of them. So I will always make that disclaimer, but the majority of multi-level marketing companies are complete and total garbage and have very little intention of helping the people at the bottom make money. They're just designed to help the people at the top make money. Most, not all. But it seems like there's some good ones out there. So I'd love to hear from them, and I'd love to hear what is it exactly that makes that company different, so that people are aware of that. But I mean, what's y'all's take on multi-level marketing? Because I got called out, so I want to give respect where respect is due.
Well, based on how you just we're talking, you might get called out again. I don't know.
Good.
You know, I can't think of one myself. So you're right. Yeah, maybe there is somebody that can shed some light on that for us. It just seems like the people at the bottom are basically feeding the ones at the top, and the ones at the bottom have nothing to show for it. So yeah, if you're out there and we're wrong on that, let us know, because it could be a good way for us to refer people to you and build your MLM.
Yep. And I don't have a problem doing that at all.
I think one of the keys to it is that whatever business you're in, whether it's the multi-level marketing or a traditional business, it requires work. And so anyone that tells you you could just put some money in here and you're going to make millions of dollars, that's not going to happen. So even people that have been successful in that, they have built a network of people that do support the business and all of that. But that has taken a lot of work to get there. So I think, to your point, the feedback that you got were some people that have been successful in it, but these are people that are already successful in other areas of their lives. And so to sell the dream that for $99 or whatever it is, you just make this one payment and you will make thousands of dollars that will change your life overnight. That's the part of the dream that is not real for a lot of people, because they were not told, or maybe they should know better, that any kind of business you're going to be in is going to require work. I mean, we're all still working, even though we have people working for us and things like that. We're not completely out of our businesses, so there's always work to be done. So I mean, I think it's a challenge for some people. I mean, to build a network of people, I mean, that is a business skill that you need. And the bigger your network gets, the more referrals and things like that you get in your business. But I think the biggest thing is anyone starting a business should be aware that it does require work. And to be successful, you continue to work on yourself and other areas of your life to get better every day.
Amen, brother.
And one thing, I mean, so we're not completely bashing MLMs. Be careful of franchises.
Oh,
I went there. I went there.
I thought I was going to get heat. You're going to get heat on this one.
Yeah, because when you're going through the process of vetting a franchise, they only let you speak to the more successful franchise owners, and they kind of sell you that dream too.
That's a great podcast.
Yeah,
the hell with franchises. Okay. Anyways, sorry.
So I won't go any further then, other than to say.
No, go ahead, man. That's a real good one, because I have a lot to say about franchises, but I won't say it on this podcast. Go ahead, finish it.
Well, that was about it. I just wanted to mention to people to do your due diligence and talk to a variety of people, a variety of different lengths of ownership, so you can kind of gauge their experience. Just keep in mind that the people that the franchisor puts in front of you are the ones that they'll know talk really good about the franchisor. They're not going to let you talk to the people that share the horror stories. So just be careful with that.
Well, the only thing that I have to share on that is I firmly believe that if the franchise has a name that is bigger than the franchise itself, like a McDonald's, like a Little Caesars, I don't know how that shit is full all the time. Like if the franchise has such a brand, I guarantee you that the barrier of entry to that franchise is very high, which means that your capital contribution or whatever requirements are in place to allow you to participate as part of that franchise is extremely high, because that franchise knows that name sells. I think where people really get into trouble is with those not so well-known franchises that are targeting certain niches. It's unfortunate, but like in 2023, we had two clients that got into franchises and had to file for bankruptcy because they just didn't make it. Like they went through all of their savings, and that's so unfortunate, because that stuff does happen whenever you go into one of these franchise models that isn't as well known as a Chick-fil-A or a McDonald's or Little Caesars or whatever. So that's the only advice that I would have there with the franchises, because if your franchise, or if the franchise that you're contemplating getting into, and this one's going to be a good one, right? We got to do this one on a separate podcast. If the franchise that you're getting into is a smaller franchise, then at least in my opinion, you're going to have all of the same disadvantages that a small business owner would have without any of the benefits of the franchise, and you're still going to have to pay the franchise a percentage of your earnings. And so now you have like both negatives working against you, and that's going to be very hard to make it successful. Can you make it successful? Yes, but like William said, the people that make those situations successful would have probably been successful on their own as well.
Yeah, and then they knew that it would suck their time, and so they decided not to go into something like that. And just go alone.
Yep, alone, just like William on a Friday night when his wife's like, "I want to see you anymore."
Well, he's got a cool office. He's got a cool office to retreat to now.
He does have a cool office. Is that real, William, or is that digital? It can't be digital. You don't even know how to turn on a computer. There's absolutely no I can't believe that that's not a real background. Like, it's got to be real.
Yeah, I mean, you're right. I can't do it, but I've invested in some people that can make me look really good. So I do appreciate it.
Good. All right, gents. Do we have anything else for today? Oh, what did you want to go over the HSA or nah? That was not very cool.
No. I mean, the amount of money that you can put in, you really don't get a good return. So, or tax savings. So, I like the reinvestment in your own business as a good strategy for the fifth one.
I do too. All right. Well, ladies and gentlemen, that's our podcast for today. We're going to try to get a little bit more niche based as we make progress. I don't know if you guys want to close this out, but I'm going to put up the email. If you guys have things that you want us to talk about, I want to make sure that we make a platform available to you. And I don't even know if we created the damn email for this podcast, because we had created an email. It was a cheers to wealth something at gmail.com. And I don't know what the hell happened with that. So for right now, you can email me if you have any questions, or if there's a specific topic that you want us to discuss, send us an email, raul@raulgomezjr.com. And me and the guys will discuss it, and we'll talk about it here. We appreciate your support, but I don't know. Close us out. Who's going to close us out? One of you two.
Well, I was pouring another crown. So,
all right. Well, William, close us out, because I don't want to hear you complaining that I talk too much.
No, you've definitely gotten better. I just want to give a shout out to our hometown heroes here in Warner Robins, Georgia. We are an Air Force based town and support the military and things like that. So we have a lot of good people here. I appreciate all the clients that work with us. We've got a few fans out here that continue to watch us each week. We really appreciate the support that you guys give us on that. And just really, I enjoy working with you guys every day. And then when we can get on here and kind of talk about some of the things that we do to help clients, I think it's going to be a great service to everybody. So we'll just cheers to wealth.
Cheers to wealth, gentlemen. All right, guys.
Cheers.
You guys have a good night. That is not the right banner. There we go.